In November 2022, the financial world was rocked by a sudden and devastating collapse. The crypto industry, already volatile, was blindsided when FTX, worth $32 billion, imploded within days. Billions of customer funds vanished almost overnight, leaving investors, regulators, and the public stunned. Was this merely a case of mismanagement, or did we witness the biggest financial fraud ever? Today, we unpack the entire FTX saga. You'll see how it rose so fast and fell even faster. This isn't just a news report. It's a deep dive into deception, ambition, and massive financial loss. We'll expose FTX's inner workings and examine how Alameda Research played a fatal role. You'll learn how its founder, Sam Bankman-Fried, became a crypto icon and then a convicted felon. Finally, we'll compare FTX to history's most infamous financial crimes. You decide if it tops the list. Chapter 1. The meteoric rise of FTX. FTX was launched in 2019 by Sam Bankman-Fried, a former Wall Street quant trader. He spotted a huge opportunity in the rapidly expanding world of cryptocurrency trading. FTX offered something unique: complex derivatives for crypto assets like Bitcoin and Ethereum. These products allowed users to bet on price movements without owning the actual coins. Traders around the world quickly embraced the platform's sophisticated features and fast interface. In just 3 years, FTX became one of the largest crypto exchanges in the world. Its valuation surged to an eye-popping $32 billion by early 2022. But its growth wasn't just about technology. FTX aggressively invested in branding and visibility. It bought naming rights to the Miami Heat's basketball arena and ran Super Bowl commercials. Celebrity endorsements followed. Tom Brady, Larry David, and other big names boosted public trust. FTX also launched its own cryptocurrency, the FTT token. FTT offered users benefits like reduced fees and access to special features on the platform. But this token would later become the cornerstone of a dangerous and deceptive financial scheme. Behind the scenes, FTX had a hidden dependency. Its operations were closely linked to Alameda Research, a trading firm founded by Bankman-Fried. This connection, though downplayed publicly, would ultimately prove catastrophic. Chapter 2. Alameda Research. The hidden engine of risk. Alameda Research was a major player in crypto trading and venture investments. It appeared independent, but in reality it was deeply entwined with FTX's operations. Sam Bankman-Fried founded both companies and retained significant control over each. FTX claimed to be a secure, reliable exchange for retail and institutional investors. But confidential documents later revealed that Alameda had special privileges on FTX's platform. These included avoiding automatic liquidation on losing trades, a protection no other user enjoyed. More disturbing was the discovery of a secret credit line extended from FTX to Alameda. This line of credit was allegedly backed by billions in customer deposits from FTX users. Alameda could withdraw massive sums without user approval or standard risk controls in place. These funds weren't just parked in stable assets. Alameda used them to make highly speculative investments and risky crypto trades. It also funded illiquid ventures and luxury real estate in the Bahamas. As crypto prices began to tumble in 2022, Alameda's losses ballooned rapidly. To cover them, FTX and Alameda devised a dangerous workaround using the FTT token. Alameda pledged its large holdings of FTT as collateral for additional loans. But the FTT token's value was tied directly to FTX's reputation and market stability. If FTT crashed, Alameda's collateral would evaporate and expose the financial black hole. FTX had created a circular system. It used a token it printed to prop up its losses. It was a house of cards, and the first gust of wind was on its way. Chapter 3. The crash begins. Leaked documents and mass panic. In early November 2022, crypto news site CoinDesk published a leaked balance sheet from Alameda. It showed that a massive portion of Alameda's assets were held in FTT tokens. The revelation was chilling. FTX and Alameda weren't separate. They were dangerously codependent. Shortly after, Binance CEO Changpeng Zhao announced his company would sell all of its FTT holdings. This move sent shockwaves through the market. The FTT token's price began to nosedive. Investors panicked. They began pulling their money out of FTX at an unprecedented rate. Within 72 hours, FTX faced nearly $6 billion in withdrawal requests. The company had nowhere near enough liquid assets to cover the flood of redemptions. On November 8th, FTX froze withdrawals entirely. Customer funds were trapped, and confidence was obliterated. Binance considered a rescue deal but backed out after reviewing FTX's financials. They cited concerns over mishandled funds and possible legal liabilities. The final blow came on November 11, 2022. FTX filed for bankruptcy in the United States. Court documents revealed a staggering $8 billion gap in its finances. It was now clear customer funds had been misused, and perhaps deliberately so. Chapter 4. Bankruptcy uncovers a web of deception. Veteran bankruptcy expert John Ray III was brought in to lead the restructuring effort. Ray, who had helped unwind Enron, called FTX a complete failure of corporate controls. He said he had never seen such an absence of reliable financial information. Investigators quickly uncovered evidence that FTX had moved billions to Alameda without disclosure. This violated both legal standards and the company's own terms of service. Customer deposits were used to fund trades, buy real estate, and make political donations. Internal communications revealed that top executives were aware of the wrongdoing. They discussed how to hide losses, mislead auditors, and keep regulators in the dark. This was not just negligence. It was calculated fraud at a massive scale. What looked like a tech startup was operating like a criminal enterprise. Chapter 5. Comparing FTX to other historic frauds. To gauge the magnitude of FTX's collapse, let's compare it to three iconic financial scandals. Enron, 2001. This energy company used off-the-books partnerships to hide debt and inflate profits. When the fraud unraveled, shareholders lost over $74 billion. Bernie Madoff, 2008. He ran the largest Ponzi scheme in history, stealing an estimated $65 billion. He paid old investors with money from new ones, a textbook definition of fraud. Theranos, 2015. Elizabeth Holmes deceived investors by claiming to revolutionize blood testing. The startup raised $900 million based on false promises and non-existent technology. Compared to these scandals, FTX may not top the dollar amount charts. But its audacity, speed, and global impact make it uniquely significant. Madoff operated in secrecy for decades. FTX rose and fell within just 3 years. Theranos misled elite investors. FTX harmed millions of everyday people and institutions. Enron's fraud was complex, but FTX's was fueled by a reckless use of customer funds. Chapter 6. Legal consequences. Justice for the collapse. The legal system moved quickly. In December 2022, Bankman-Fried was arrested in the Bahamas. He was extradited to the US, where he faced several federal charges. Prosecutors charged him with wire fraud, securities fraud, and money laundering. They alleged that he knowingly orchestrated a massive scheme to defraud customers and investors. Several top FTX and Alameda executives pleaded guilty and agreed to cooperate. Caroline Ellison, Alameda's former CEO, and Gary Wang, FTX's co-founder, gave key testimony. They detailed how customer funds were funneled into risky trades and personal expenditures. In November 2023, a jury found Bankman-Fried guilty on all counts. In March 2024, he was sentenced to 25 years in federal prison. He was also ordered to forfeit over $11 billion in assets tied to the fraud. The verdict marked one of the harshest sentences for a financial crime in US history. It sent a clear message to the crypto industry. Accountability is non-negotiable. Chapter 7. The future of crypto. Trust regulation, and recovery. FTX's collapse shattered confidence in cryptocurrency exchanges across the globe. Millions of retail investors lost access to their savings. Some lost everything. In response, regulators worldwide began crafting stricter rules for crypto markets. These include custody requirements, ensuring customer funds are kept separate from business assets. Exchanges are now being pushed to undergo regular independent audits and prove financial solvency. There's a growing push for investor protection. Governments are exploring mandatory disclosures and better education for retail investors. Even celebrity endorsements of crypto products now face legal scrutiny. Still, critics argue global crypto regulation remains inconsistent and incomplete. As new platforms emerge, the risk of another FTX-style collapse remains real. But many in the industry believe FTX was a wake-up call. Exchanges now emphasize compliance, transparency, and better governance. Survivors of the crash are rebuilding with new priorities and more cautious users. Chapter 8. Final Lessons. How to protect yourself in crypto. FTX taught the world that even the biggest platforms can hide devastating secrets. Here are 5 lessons every investor should remember. 1. Avoid unregulated platforms. Stick to exchanges in jurisdictions with strong legal protections. 2. Diversify holdings. Never keep all your funds on one platform or in one asset. 3. Demand transparency. Choose exchanges that publish regular audits and proof of reserves. 4. Watch for red flags. Over-reliance on self-issued tokens and complex structures is a warning sign. 5. Do your homework. Research founders, finances, and business models before investing. And above all, if something seems too good to be true, it probably is. In conclusion, is FTX the biggest fraud ever? While FTX might not surpass Madoff or Enron in raw dollars, its deception was just as bold. It exposed deep vulnerabilities in the fast-growing, lightly regulated crypto industry. For many, it was more than a collapse, it was a betrayal. A betrayal by a platform they trusted, by a founder they believed in, and by a system without safeguards. The $8 billion hole left behind isn't just financial. It's a scar on the credibility of crypto and a lesson that trust must be earned, not assumed. Engage with us. What do you think? Was FTX the biggest fraud of our time? Or does another scandal take that crown? Share your thoughts in the comments. And for more insights into financial crimes and crypto frauds, subscribe to our channel and stay informed.